I got a call yesterday from someone who'd been watching my videos. They said, I'm 60 and I have $2 million, all pre-tax. How do I minimize taxes? It's a great question and one I hear all the time. Today I'm going to show you exactly what you need to think about if all of your money is in pre-tax accounts. And I'm going to walk you through a specific strategy that can save you over $1 million over your lifetime. Hi, my name's Jeremy, and I've been helping people successfully retire for nearly 30 years. Let's get into it. Before we get into the math, I want to share something with you. If you're approaching retirement and all of your money's in pre-tax accounts, you didn't do anything wrong. The 401k was designed to have tax-deferred savings, and a Roth IRA didn't come around until the late 90s. And when you're in your peak earning years, saving pre-tax is usually the smartest move. Look, you did the hardest part. You saved the money, and great job. Now let's talk about how you can get the money out the right way. Okay, let's start with the basics. You're 60, you got $2 million, and it's all pre-tax. If you follow the traditional 4% rule, you can withdraw $80,000 a year. But here's the catch. That's $80,000 of taxable income. Every dollar you pulled out gets taxed as ordinary income. So if you need $80,000 to live on, you need to gross it up. In other words, you need to withdraw more than the $80,000 to cover the taxes. Now, depending on your tax bracket, you might need to pull $95,000 or $100,000 just to net the $80,000 in spending money. But here's something sneaky that many people miss, and I need you to pay attention to this next part. When you're working, your income dictates your taxes. I know that's obvious, right? When you first retire, your withdrawals dictate your taxes. Okay, still obvious. But once you've been retired for a while, especially with a large pre-tax portfolio, it's actually the size of your portfolio that dictates your tax bill. Let me repeat that. It's the size of your portfolio that's going to dictate your tax bill. And that's because of something called required minimum income distributions. Between the ages of 73 and 75, the IRS forces you to start taking money out of your pre-tax accounts whether you need it or not. Here's the problem. The larger your portfolio is, the larger your forced withdrawals are. And it's important for you to know how this works. Let me show you what it looks like. Here's an RMD table that you have the ages on the left and the distribution period on the right. And here's how the math works. At age 75, your distribution period is 24.6. You take 1 divided by 24.6, and that comes out to be 4.065%. The following year, the distribution period is 23.7, which works out to 4.219%. You see, the older you get, the more percent you have to take out. By the time you're 81, you're taking out over 5% of your portfolio. And you need to take that money out by December 31st of that year to avoid penalties. Okay, now that you know how RMDs work, let's get back to the example. Say you retire with 60 with $2 million. You're only pulling out what you need, which is around $80,000 a year, adjusted for inflation after tax. If your portfolio keeps growing, let's say by 8% per year, by the time you turn 75, it may be worth over $3 million or more. Now, when those RMDs kick in, you're forced to withdraw $150,000, $200,000, maybe even $250,000 a year, whether you need it or not. And that is all taxable income. And that can push you into higher tax brackets and trigger Medicare surcharges called IRMA. It's possible for someone with $2 million in pre-tax accounts to end up paying $3 million or more in lifetime taxes. Now, that's not a typo. The IRS can end up getting more than what you started with because of inflation, growth, and forced withdrawals compounding over a 30 or 40-year period. But don't worry, I'm going to show you how to fix it but you need to fix it before your RMDs start. Let me show you what this looks like with a real case study. Elaine Bennis was single, 60 years old, and she saved $2 million working as an editor with Peterman Catalog. All of her savings were pre-tax. It was in a traditional IRA. She wanted to spend around $80,000 a year in retirement, adjusted for inflation, and she was planning for a long retirement. You see, Elaine had longevity in her family, so she wanted to plan to age 100 just to be safe. When we run the numbers with no tax planning, just pulling out what she needed each year, her lifetime tax bill was projected to be $3.27 million. Yes, $3.27 million. I know that sounds impossible. How in the world can someone with $2 million pay $3 million in taxes? Here's how. $80,000 a year adjusted for 3% inflation over 40 years adds up to over $6 million of lifetime spending. But because of RMDs, and now you know how RMDs are calculated, right? She was forced to withdraw more income than she actually needed. And all that extra forced income gets taxed. And you know, the older she got, the more she had to take from her IRA, and that pushed her into higher tax brackets. And she ended up paying more for Medicare. And by her 80s, she paid extra every single month for Medicare because her income was too high. So here's what we did. Step one, we had her delay Social Security. Instead of claiming early, we had her wait until age 70. This gave her a larger benefit, which became around $44,640 per year. But more importantly, it created room in her tax bracket during those early years of retirement for Roth conversions. Step two, we filled that room with those Roth conversions. From age 60 to 74, we converted $30,000 a year from her traditional IRA to the Roth. Yes, she had to pay taxes on those conversions, but she paid those at a lower rate while our income was still relatively low. That money then grows tax-free in the Roth IRA, and that is not subject to RMDs. Let me show you what that looks like. All right, so what we have here on this chart here is, this chart is showing the different tax brackets, as you can see with the different lines, going forward into the future. Now, on what you have here on the columns is Elaine's baseline income withdrawals. Then you have base case ordinary income withdrawals if she did a $30,000 Roth conversion each and every year. Now, what you can notice here on the right-hand side is that if she didn't do any Roth conversions, you can see how much more in taxes she would have to pay because she's in the higher and higher tax brackets toward the end of her plan. Now, when you look down here, the total projected lifetime taxable amount is $3,272,000. But if she did a Roth projection, converting $30,000 a year, that's only $2.2 million. And the difference is $1,044,000 over her lifetime. On this chart, you can see a visual representation of how much taxes she pays each and every year. Now, you can see in the very beginning on the Roth conversion scenario, she obviously pays more taxes earlier on if she does those Roth conversions. But what ends up happening is she pays a lot less later because she did those conversions in the beginning, as you can see here. On this chart, it shows how the IRMA surcharges happen each year in retirement for Elaine. And then you can see the total IRMA surcharges if she did no Roth conversions, which would be $276,000. But if she did those Roth conversions, she'd only have to pay $200,000, and that's a savings of $76,000 over the course of her lifetime. So with all the normal inputs, 8% per year, taking $80,000 a year, index for inflation, after tax, here you see the total portfolio ending amount if she did no Roth conversions of $12,473,000. If she did Roth conversions, it'd be $13,122,000. So that's a $649,000 difference in portfolio ending amount between no Roth conversions and doing Roth conversions. Now, as we mentioned before, all portfolio accounts are not created equal. So when we take into consideration her having more money in a Roth IRA versus a pre-tax IRA, and you do apples to apples, when you take into account the after-tax value of the portfolio, doing Roth conversions or not doing Roth conversions, the projected difference is $935,000. And when you add back in the $76,000 that you could be saving from IRMA surcharges, you're looking at
$1 million.
Step 3, we created a withdrawal sequence. In the early years, she lived off the combination of her pre-tax withdrawals, and we kept her in the lower tax brackets on purpose. Later, once Social Security kicked in and her RMDs started, she had a pool of tax-free Roth money to draw from. That money didn't push her into higher tax brackets or trigger Medicare surcharges. The result was her lifetime tax bill dropped from $3.2 million to $2.23 million. That's over $1 million in tax savings. Her Medicare surcharges, the IRMA cost, dropped by $76,000. And her ending portfolio value at age 100, that was a $649,000 higher with Roth conversions. Now, all accounts are not created equal. You know that if you have $1 million in a pre-tax IRA, that's not the same as if you had $1 million in a Roth IRA. So when you look at the after-tax value of the numbers at the end of age 100, that's a $935,000 difference. And when you add that to the IRMA surcharge savings, you're looking at over $1 million in savings for Elaine. Same spending, same investments, and same investment return. Just smarter tax planning. So for the person that called in yesterday, would this video be helpful for her? Probably. We covered a lot, but let me share with you some important things we didn't cover, and they may affect her and maybe you too. First, tax rules change. We had a big change last year. Your situation changes through time. Nobody consistently takes the same amount of money over a 30, 40-year period. Life happens, and it's supposed to happen. You may need more income for a special trip or help a family member out. And when you do, the amount you need to convert to a Roth IRA changes. You may be married, you may get divorced, or you may inherit wealth, all of which would change a lot of these numbers. You may have kids that make a lot more money than you do, and it may be cheaper for you to pay the taxes or vice versa. And if you want to give all of your money to charity, none of this may matter anyway. Also, Elaine ended up with $12 million in her estate. If you want more money to live your life, increasing withdrawals may need to be considered each and every year so you can live the life you want in retirement. So, what do? The best you can with the rules for today and your situation today, while projecting out the best you can into the future. You need to have a plan that's flexible and moves with you. Now, I know that's asking a lot. So if you'd like some help, you can click the link in the description and you can set up a time to talk to us to see how we might be able to help you. Thank you for watching, and I'll see you in the next video.